what are the stocks they failed to buy
Hmm.
and what are the stocks they failed to sell.
Hmm.
Okay, and then it gets from 2D, it becomes a 4D analysis.
A fund manager calculates alpha. Why are they not looking at a set of basket of stocks which are like tremendously outperform? Are they not answerable that why have you not invested there?
Who survived Nifty 50 all these years? Okay, this is a handful of stocks that has been there since 1996. When it comes to asset allocation, I tell people that it is all about your familiarity with the assets more than the asset class attributes.
Hello everyone, welcome to yet another face-to-face investing. Friends, I recorded a face-to-face with an amazing gentleman today. The person is an investor, the person he's an author, he has written an incredibly good book, and the person is so impressive that while I was knowing more about him, he told me that he is publishing his portfolio on his website on a regular basis without any obligation just to make sure that he can see his improvement. Oh my God, that's serious thought process. And I think I'm very impressed with that person. While I've already recorded the video is very structured way of learning investing the way it should be done. He talked about his book as well. I would seriously recommend people to read his book. But I think the overall discussion was quite enriching. And people who love investing or who would like to get into the path of investing, I think this is going to be a great starting point for them. So let's invite Raghu sir into our conversation. Hello, Mr. Raghu. Welcome to Face to Face.
Thank you. Pleasure to be with you, Vivek.
Super excited. I'm very, very excited. I have been following you for some time. I know you have written a marvelous book, and it's such a pleasure for me to talk to an author who has written a practical, sensible book. So, sir, very, very happy. So, you are from Chennai, if I'm not
Yes,
wrong. So,
absolutely.
and I know that in Chennai, we have some really big investors in terms of investing, great value investors. So I can understand that this video is going to be enriched with lot of investing wisdoms from you.
Sure. I'm very, very happy to be on your show, Vivek, and thank you for your very generous words. And I will definitely strive to live up to the expectations. I will make an effort for sure.
Lovely, lovely. So cool. Raghu sir, I'm going to use Raghu for you if it is fine. Uh,
Absolutely.
so Raghu sir, we need to know more about you. I mean, you are not available anywhere and everywhere. You are a very selective person. Actually, I came to know about you through a CFA event. Someone told me that he's a great speaker. You should call him. So social media, I don't think so. You are so active. So we need to know more about you, Raghu. How did it all start? A bit background. Maybe you would like to go to your college days and talk about what you did in your college.
Well, yeah, my early life has been like anyone. I've been very, front bencher, not a back bencher. Okay, so I've been topping the class, and of course, I studied in a normal school, but I've always excelled in my academics, which enabled me to get into one of the prestigious colleges in Chennai called Loyola College. The beauty is that if you go to a good college, you get good peers. So,
Yeah.
and they shape your thoughts very well. That has helped me a lot to be surrounded by very intelligent people, always trying to achieve something more in life. So that is something that I would really, I had a good start in spite of being a normal middle class background like all of us actually. But the big turning point came when I left my government job with Unit Trust of India,
Oh,
and in search of a career uh, in equity research. So at that point of time, that was considered a very insane move. But I could clearly see that if I continue to work for public sector, I can go only that far. And at that stage itself, I've developed a lot of interest in investment research, investment management, and
Mhm.
I pursued CFA. I went to Middle East to work, and the turning point I would say came in 2003 when I finished my CFA charter
Okay.
from US. So that opened up a very different set of friends and professional associations for me. I just did not celebrate my CFA charter by sitting quiet, but I started associating myself very closely with the institute.
Okay.
I did several things for the institute, and I am still a grader for the institute for the level 3 of the CFA program. I've been, with working with the institute in several capacities as a society leader and what have you. So, but the turning point, I would say, if you split Raghu's life into two, it would be pre-CFA and post-CFA. It's as
Wow.
simple as that. Yeah.
Lovely.
So that's a very, key turning point for me because it opened a lot of doors and it provided the respect. It gave me the career break that I wanted. I got the position of head of research for one of the largest investment banks in Kuwait, which position I held for nearly 20 years. And that position enabled me to give a lot of interviews and opinion as head of research. So all that was possible only because I am a CFA charter holder. So I think that was the biggest turning point, though I pursued relatively late in my life. When I passed my CFA, I was 35, I'm sure. So these days, kids pass, quite early the
Yeah.
exams. But better late than never is the slogan, and I see that as a very big turning point. And of course, the second big turning point has been my book publishing, which happened in September last year.
Mm-hmm.
Blueprint for Billions, focused exclusively on India's equity markets.
Mm-hmm.
And I'm very, very happy about the second milestone as well. So that's basically the nutshell of my journey. Of course, I'm not a very active social media person. I don't go to Twitter and provide my opinion every third minute. Okay, but I am active on LinkedIn, but
Okay.
only through my very curated, researched articles.
Okay.
So I don't involve in quick conversations, but I believe in reading a lot and providing some sort of thoughts for greater takeaway. This is my style. So you're right in that sense. I'm a little bit quiet from the noise that happens around us, but that's probably it gels well with my personality as well, actually.
Superb. So we'll give you a LinkedIn link in below this video so that people who want to consume those very relevant content can go. Unfortunately, today's world is all about long, short, very
Yeah.
short, noisy content.
Just for your information, I publish a monthly newsletter called
Okay,
Macro and Markets.
nice.
So, and I analyze every month. I am a big believer in macro.
Mm-hmm.
So I think with what is happening now, everyone will agree with me that macro shakes up the world.
Yeah.
So, I've been doing this for a while now. So that's something that people can read and, give their views.
Wow.
Actually.
So that means people can follow you on LinkedIn and get access to that monthly newsletter. You
Yes,
post
yes,
it there. All right.
absolutely.
Fantastic.
Yeah. Yeah.
Very good. So I'll be one of your, consumer of your ideas. So
Thank
let's
you.
talk about, apart from the book and other things, are you a active investor in market?
Of course.
Okay.
I'm an investor in Indian market and I publish my portfolio on my website. I've been doing this for several years, and the
Okay.
portfolio, the PPT that I publish is a very detailed one. It gives you several dimensions of my portfolio, the stocks that I sold, the stocks I bought, the risk and the performance, long term,
Wow.
short term, the cap weighted distribution, the sector weighted distribution. So it will look and feel like a mutual fund newsletter for you, but
Love.
it's all about my individual portfolio because
But
I believe that
you don't
I
manage other
need
people's
to.
money. You're doing it your own portfolio, you manage your own money and you're publishing
Yes,
it. It's
absolutely,
like
yeah.
serious discipline.
Yeah, just to, yeah, you're absolutely right. Just to make myself more disciplined. That is why I do that year after year, actually. Yeah.
Superb, sir. This is amazing. So inspiring. In fact, yesterday I read it somewhere, which was quite apt with you, that discipline is the supreme form of self respect. And I can clearly see that how much self respect you have for yourself, that you are publishing your report card for yourself on internet. This is truly amazing. I hope I can do some
Yeah.
bit of what you are doing.
Thank you. Thank you,
Do you have
Vivek.
any plans of managing other people's money or?
Yeah, definitely. I mean, that's my future plan for sure. And asset management has always, attracted my attention. And I always say that, compounding can is an easy job, but people make it difficult unnecessarily. So my idea is to basically take advanced concept of portfolio management and apply that to managing other people's money. But for that, we need to first build our own track record and show that the engine works, and then solicit others, friends, and institutional money for sure. Yeah.
Lovely,
I
lovely.
mean, the party is just beginning in India. I'm sure we have some exciting times in the next 20-25 years of money management that is likely to happen.
Well, I'm very glad to hear that the party has just begun in India. It's just that what time is right now? Is it 7 p.m. or it's 10 p.m. or it's 1 p.m.? Because anyone who comes to the party is a beginning of the party for that person. But I'll pick your brain on that, especially in the current scenario where things have not actually gone the way we all were expecting. But I will pick your brain while you go through the presentation. You have made a brilliant presentation, and a lot of things as part of your book as well. So I would seriously recommend people to read your book in length to get more from you. But this presentation is a good framework for us to understand how equity market functions and how India can help us to reach that wealth creating objective which we have. So would you like to share a screen, sir, and just go through the presentation, sir?
Absolutely.
Yeah. And as a obedient learner, I will be stupid enough to ask you stupid questions. So please pardon me if you find some of my questions very trivial.
I always tell people that no question is stupid so long as it doesn't have an answer.
Oh
So,
wow, this is so good. This is
because
so
this
good.
is all how we learned by asking our teachers stupid questions, right? So, I
Yeah,
mean, it's perfectly all right. Questions are welcome, and questions enable me to think through the aspect much, differently. So
absolutely.
it's not that you ask a question and I give a response. When you ask a question, it triggers several dimensions in my mind as well. So I always thank people when they ask me questions.
Lovely.
All right. So just to give you a small introduction about my book, this book has been published in September 2024 in
Mhm.
India, and it's titled as The Blueprint for Billions. And the term billions can be understood as money, or it can also be understood as India as a billion plus population.
Mhm.
So in either case, the drive for publishing a book is I felt that India is now at the threshold of a breakout for the next 20-25 years.
Mhm.
All stars are beautifully aligned for an emerging market like India. It's been on the sidelines for a very long time. And now we see that real institutional money is coming to India. And when that happens, the professional literature on our markets should be also strong. and more than very high sounding, uh, high level type of thoughts that hits the social media and newspapers. People also should have some source to really look at well researched ideas into what our market is all about, what are the plus and minus of this market. So basically I want to fill one more literature to an already a good litany of books on Indian stock market, but this is my small attempt to just add to that portfolio of knowledge that foreign investors and institutional investors will find it very useful. So, as you can see here, I start with the big picture, and then I go down. And the analogy that I have used is that of a plane. Okay, so when you are flying at 30, 35,000 feet above the ground level and look at the ground looks so beautiful, so clear, and it's such a treat to watch. And then you keep descending, step by step, and when you finally land, then you see all the cars and the auto rickshaws on the road, and the sound and the noise pollution. So from a very quiet, beautiful view, you come down all the way to a very noisy street type of a view. So sizing the big picture is that 30,000 feet job, and investing in stocks is that ground view, actually. So I then make a systematic effort to take it one by one as you descend. And basically, once you have a reasonable idea of how to size the big picture, then you need to also have some building blocks in terms of fund management and market timing and what have you. And then you have several ways to nirvana, and I call them as equity styles and themes. So I discuss in this book all the types of various styles. I'll go over them very briefly. And then one can also look at the same thing from a sector point of view, because every country has some specialization and some aspects of sector understanding that will be very key to stock market investing. For example, in India, it would be the information technology, which is a very interesting space from a sectoral point of view, or pharmaceuticals, or petrochemicals, or banking. So we have some key sectors that move the needle, and it is very important to really get a grip on them. And finally, investing, the process of investing, how to really get to dirtying your hands in terms of crunching the numbers, and then finally selecting A versus B in terms of investments. So this is the architecture of this book. And of course, as I said, India is an excellent story to pitch. And we have demographic dividends, and we have the size, we have the scale, and we have the ambition, and we have the young brains to propel this country from a developing to developed status in the next 25, 30 years. And if you look at any country in the world that has traveled this journey from being developing to developed, the amount of um, profits that one made in the stock market is humongous. So it's a no-brainer to ride this wave. And whether you look at forecast for 2030 or 2050, I mean, it's going to be mind-boggling in terms of the projections that we are seeing. So we'll have more airports, we'll have more demat accounts, we'll have more people filing for taxes, we'll have more GST collected, we'll have more adults working in the system. So it's a good place to be in from an investing point of view. However, like any economy, every economic system is very chaotic, and that's why I call it as the web, the economic web.
Yeah.
It's not a very simplified structure at all. Of course, I have created some pillars here like GDP or demographics or credit or inflation, trade, employment. But within each pillar, you can see there are so many sub pillars that operate. And if you press one, something else crops up. And if you press that, something else crops up. So that's why it's never a very straightforward analysis of the economy. So understanding the economic web and how they, move the wheel is very, very important for us to understand what happens. So when interest rates move up, what would be the impact on the currency, and what would be that impact on trade? So everything is highly interlinked, and this book discusses in depth the type of interlinkages that this web produces. It took a lot of time for me to create this design, but I thought it is so useful for someone to understand the complexity of economics, which is very, very difficult. So that leads us to very key work, like, for example, how do you estimate interest rates? Because it affects bond markets, it affects equity markets, it affects real estate, cap rates, everything. And being a highly import-driven country with more than 70% of oil being imported, what that means for energy security, demand, supply, renewables, and what have you. And finally, very interestingly, how do you invest in extraordinary times? And I would clearly label current times as an extraordinary time.
Yeah.
The last time I saw an extraordinary time was COVID.
Yeah.
And then before that was the global financial crisis. So extraordinary times come in regular intervals. Within 4 to 5 years or maximum 10 years, you have one episode coming and hitting you. So when that happens, how do you do that? And in this book, I have said that the best tool to use during extraordinary times is to create scenario analysis. So you create possible scenarios. If you take, for example, the tariff tantrum played by Trump, now all of us know what he's doing, but few of us can see the picture 6 months or 1 year from now. And that's exactly the scenario analysis. Develop 2, 3 plausible scenarios, assign probabilities, and take investment decisions. So that is a very interesting and relevant chapter to read in these times from this book. And once you have some mastery over the big picture, then comes the aspect of building blocks. And one of the key building blocks is the fund management. The fund management is the concept on which the entire mutual fund industry is based. And all they do is just 3 things. They try to see what to buy, they try to see when to buy, and they try to see how much to buy.
Right.
Most of them get the 1 and 2 correct. Okay, it's easy to identify what to buy. I have given a template, and if you number crunch that template, obviously it will give you a good set of stocks to buy. When to buy is also not a very difficult call, because you have to wait for times like this when markets crash, and therefore, it's a good time to buy. Or if you can't decide, you just have a systematic way of investing. But the third and the most important thing is how much to buy. And this is where even fund managers get it completely wrong. So it's not enough to know or identify good stocks, but it is also important to put your weight behind those conviction stocks, so that when the real upside happens, it moves the needle. Otherwise, I've seen a lot of portfolios where good stocks have so low weights that even if they are 10x, they're not going to move the needle. So that those things are handled in that chapter. And I also have dedicated a lot of articulation around mutual funds, because there's a lot of investments in mutual funds during the last few years, which is very good, because retail investors going through the institutional route for managing money is a very highly professional thing to do. And this is one industry, mutual fund industry, that has grown phenomenally during the last decade or so. And but very curiously, the landscape has been dominated by domestic players rather than foreign players. For
Yeah.
some reason, there were a lot of foreign players who came in and who exited our Indian market because they found it to be very high cost. They were not able to scale and they couldn't manage the regulations. And for them, India was not a core market because, in the overall scheme of things, our allocation is very small from a global portfolio manager's point of view. And therefore, it gave rise to a very dynamic M&A landscape where they sold their positions to local banks. And today, if you look at the top 10 players, most of them are domestic banks, and I feel that that structure is going to continue for some time to come.
Okay.
And also fund management, the case for fund management is because I expect them to generate alpha for me. So how easy or difficult it is to generate alpha, because empirical evidence at a global level shows that most of the fund managers do not generate alpha. So that is why there is a great move towards ETFs and asset allocation away from mutual funds. However, emerging markets are different. Emerging markets by nature are inefficient, and inefficient markets provide a lot of room for alpha generation opportunities. And we do find a lot of mutual funds in India generating those alphas, not only absolutely but consistently. So this is a study as to how consistent the alpha generation is. I coined a term called persistence in performance, and I explained that there are some funds who are very persistent when it comes to generating performance, and investors should go behind those funds. And of course, fund
So,
management.
Raghu sir,
Yeah.
just one question. Going back to the slide, when we so there is a big debate right now with respect to active fund management and passive fund management. So, is the data trying to conclude that active fund management is actually better in India?
Yes. Actual active fund management is always better for emerging markets.
Okay.
As markets mature and become efficient, then a shift to passive will make sense. But till then, I think there is plenty of scope to generate alpha.
That means the yield of AMCs will always be high because active fund management is the where they generate more bottom line for their business.
Yes, absolutely. Because it's a growth market.
Mm.
And even if you don't perform well in absolute terms, your assets under management will still grow
Got it.
because of systematic investment plans and what have you.
Got
But
it.
the book also outlines players who have achieved both performance as well as growth in AUM.
Okay. Okay.
Yeah.
Very
So this is a very interesting chapter that talks about the dimensions of fund management, because at a very basic level, fund managers buy and sell stocks,
good.
and that's two-dimensional in my view.
Hmm.
But what is very important is also to analyze what are the stocks they fail to buy
Hmm.
and what are the stocks they fail to sell.
Hmm.
Okay, and then it gets from 2D, it becomes a 4D analysis,
Okay.
because there are stocks which you must have failed to buy but must have gone up.
Hmm.
So that will actually be negative alpha for you.
Correct.
And there are stocks that where you must have sold, but you held on to it because of conviction or whatever story. But again, if that stock price of that stock goes down, then it is negative alpha. So missed opportunities and missed bets are as crucial in fund management as real opportunity and real bets. And I give some examples on how this four-dimensional assessment of fund management and fund managers can actually be put to use. And some of the reviews that I got from mutual funds say that they can actually use this template for their own internal analysis.
Yeah. It's very interesting to have some discussion on this because typically when we calculate alpha, it is always with respect to a benchmark index.
Yeah.
And benchmark index has its own inherent problems where the performers, the outliers never gets, highlighted, right? Because ultimately benchmark index is a weighted average. So it will come to that mean level where most of the assets have performed. Or maybe if there are more outliers, then obviously the outperformance will be high. So when anyone, a fund manager calculates alpha, why are they not looking at a set of basket of stocks which are like tremendously outperform? For example, say Adani. Adani Group stock performed tremendously, and there were certain funds who were not owning them at all. So, are we not? Are they not answerable? That why have we not invested there?
Exactly. That's the quadrant here that is titled as missed bets
Yeah,
or fail to buy. And once you fail to buy something, and if that stock goes up,
yeah,
then you have missed adding alpha to your portfolio.
yeah,
So
yeah, yeah,
an analysis of a fund manager should not be just two-dimensional, but it should be four-dimensional.
yeah,
But
yeah,
it's a little bit complicated to view it four-dimensionally. But with computing power, anything is possible, right?
yeah, 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 yeah.
Yeah.
But anyways, a normal mutual fund investor will not be able to understand
Yes.
the complexity. I think it should be more internal review purpose for
Yes.
the
And it's
AMCs
more of
rather
an
than.
institutional dimension that I'm
Yeah,
giving here,
yeah, yeah, yeah.
rather than the retail one.
But that's very interesting perspective you gave,
So,
sir.
and
Mm.
also when it comes to fund management, there are, I mean, I call this as stars, dogs, and darlings.
Mm.
So
Mm.
there are stars like, for example, Infosys, Reliance, Maruti. You are wedded to these stocks because they have very high weightage in the index or the benchmark, and if whether you like it or not, you can up or down the weights a little bit, but you have to be they have to be stars in your portfolio. You
Mm.
don't have a choice. um, but so they are called darlings, and
Mm.
then there are stars. I mean, the stars are the stocks where fund managers have shown least interest, but they have gone on to perform very well, like
Mm.
your example of Adani. And
Mm.
then we have dogs, where we have some fund managers investing, but these companies have done really, really very poorly.
Mm.
So most of the time, fund managers are very good at avoiding dogs and embracing stars, but they have to be structuring their portfolio around darlings because of the heavy weight that they enjoy in the benchmark. Now,
Mm.
moment you break free from these shackles, then I
Mm.
think the real performance of the fund manager will come out rather than trying to be in this mold.
Mm. Mm.
And of course, market timing is a huge topic of discussion.
Mm.
And academic research shows that one should not time the market.
Mm.
But we always listen to that advice, but may never follow, because it's so tempting to time the market, especially in times like this. If someone has been buying a lot yesterday, imagine the type of money they would have made today. So,
Mm.
market timing is something that you cannot ignore, because it's instinct to time the market. Normal conversation with friends always start with, is it a good time to enter the market? Is it a
Mm.
good time to buy? Is it a good time to sell? So the term time, keeps coming up in conversations very often. So I tell in my book that please don't try to time the market, because you will never be successful in
Mm.
timing the market. But if at all you have the urge to do, then follow it with some sort of a quant process that will make sure that you don't burn your capital. And that chapter is titled as Buy Low, Sell High. And it is just a demonstration, a small demonstration of how to institute a quantitative portfolio management into achieving market timing.
Mm.
So I will not get into the nitty gritties of it, because it is already explained in the book. And from a market timing point of view, for example, a lot of people, when markets hit lifetime highs, for
Mm.
example,
Mm.
Nifty has been hitting lifetime high for the last 3 years regularly. So when markets hit lifetime high, is it a good time to buy? Is the question. Okay, whether it is a stock or a market, you always have more confidence to buy them at the bottom, not at the top.
Mm.
But here is a research that analyzes this, factor, and concludes that after all, investing in peaks is not does not produce that much of bad odds compared to investing in trough.
Mm.
Of course, we have so much troughs compared to peaks in the market. The
Mm.
data shown here is staggering. But you will not be a bad performer even if you invest in peaks. But the only problem is that I've done this back exercise just to prove a point that even if you invest in peak, you can still make money.
Mm.
But again, whether it is a trough or a peak, you will know only post facto and not anti. So it's always a rear view mirror that something is trough, something is peak. Okay, if I want to know what will be the peak next month or what will be a trough next month, I don't have an answer for that.
Mm.
So we have to be very careful. But the idea is that market timing, it's a flawed understanding that if you invest in peak of the market, you will lose money. So that is not the case. And again, a lot of statistics to prove the same point given in
Mm.
the book. And obviously, being staying in the market produces good outsized returns, but avoiding certain days of peak performance of markets or strong downturns like yesterday will produce completely a very different sort of a
Mm.
result actually.
Mm.
So
Mm.
missing out on best days affect the returns significantly, and I have done this calculation from an Indian market context just to
Mm.
say that stay in the market, invest all days, so that the first blue bar is what you will get in terms of outcome. If you try to time the market and then you go wrong and you miss the best days, then your return comes down dramatically, as you can see from this chart. So
Mm.
that's about the building blocks. And then I discuss in this book some styles and themes, equity styles and themes. So equity markets are known for large cap, mid cap, small cap. That's a size dimension. Or equity markets can also be around concentration versus over diversification. So there are portfolios with 500 stocks, there are portfolio with 5 stocks. Okay, 5 stocks do the diversification job as efficiently as 500. That's what the theory says. But there is always this temptation to have a lot many stocks in your portfolio than what is warranted. There is also this core and satellite approach where you can keep your simple equity debt portfolio at the core and then build a lot of satellite opportunities like private equity or derivatives around it to get that extra alpha. Then there are multi-baggers, how to deal with them. Then the debate on active versus passive that you were asking about some time back. Then how to be a contrarian investor, move against the tide, buy when everybody is selling or sell when everybody is buying. Of course, the celebrated value style of investing, momentum style of investing, dividend yield style of investing, or penny stock investing, or IPO investing. So I dedicate a chapter to each of these thoughts, in this equity styles and themes. So when it comes to size, we have large cap, mid cap, and small cap. But
Mm.
remember, everything started small cap and then
Mm.
they progress to mid cap and then they eventually become large cap. And I give an
Mm.
example here about Eicher Motors that started way back in 95 as a micro cap, and
Mm.
today it's a large cap. So obviously there are advantages and disadvantages for each types of cap based investing. For example, when it comes to small caps, obviously the potential for outsized returns are very high, but they also endure a lot of cost and margin pressures. They have very high failure rates and they have extremely poor corporate governance. So you have to be very conscious about those facts before you really zero in on this type of an investing.
Mm.
Or concentrated portfolios are good because good ideas are very scarce, and if you have handful of stocks, it's easy to track and research. Risk reduction still happens at a 5 stock portfolio compared to a 500 stock portfolio. And if you just have 5 stocks and based on how each stock performs, it moves the needle of the portfolio very well. if you have 500 stocks and if the 490th stock is just 0.02% of your portfolio, regardless of what happens to that stock, it just does not move the needle for you.
Hmm.
And it leverages more on your skill than luck, because if you just have 5 or 10 stories to focus, you will be very obsessed with them. If you
Hmm.
have 500 stories to focus, obviously you are spread very thin. But there is also, dangers of concentrated portfolio, because all eggs in one basket syndrome. It's definitely not suitable for retail investors. It has very high tracking error, because a benchmark like Nifty 50 has at least 50 stocks. And if you have only a 5 stock portfolio, then that induces a lot of tracking error while comparing it with the benchmark. And
Hmm.
then, of course, there are some asset allocation issues as well. And as I explained, the core and satellites approach, at the core is your simplified portfolio, but on the satellite are several opportunities, like you can give sector funds, you can have private equity funds, you can have factor investing, and there are a lot of possibilities, thematic, forms of investing like ESG, and you can build portfolio insurance. So these are very advanced portfolio management concepts that I discuss in the book. And of
Just
course,
one question in that previous slide, sir.
yes.
When you say core portfolio,
Mhm.
um, satellite portfolio, as I can understand, these are specialized um, products or specialized basket of stocks or
Yes.
derivative, whatever. But how do you define buildup of core portfolio? Well, does
Core
that mean
portfolio.
necessarily core portfolio is large cap, tried and tested
Yeah,
products?
it could be a 60-40,
Okay.
60 equity and 40 debt, both in ETFs, for example.
Okay.
Okay, so that, it's a very simple thing, and you keep it, untouched. And
Hmm.
then you play with all your ideas around the satellite,
Hmm.
which can be popular, volatile, illiquid, quant based, theme based. The derivatives, for example, can be an expensive form of insurance. So if
Yeah.
you build that into the main portfolio or core portfolio, then the chances of you blowing up increases
Right.
phenomenally. So keep it to the satellite part of it, then you're fine. Okay,
Sure.
if there is an upside, it helps additional alpha. If there is a downside, it's only 20%, so it will not really hurt you.
Sure. Got it. So that means core portfolio is a composition of equity and debt, and that depends upon your age and the risk profile which you have.
Absolutely,
Got it,
absolutely.
sir. Got it.
Indeed. And then this value investing is so much talked about, but it's definitely not a cakewalk, because
Hmm.
it's highly research intensive.
Yeah.
Importantly, it needs a lot of mind control and patience, because you have to do the research to find what is a good value company. And once you have identified the conviction opportunity, then what happens when the price goes down? Should you buy more? Should you panic? Or should you revisit your assumptions? That's a lot happening in the value space.
Yeah.
But at the end of the day, the output is that you get great companies at good price, and they all perform very well during strong economic cycles, and definitely outperforms growth stocks in the long term, but definitely performs very poorly during weak economic cycles. And there is an opportunity cost of waiting for the value to emerge, and that is a patience game. And also, it requires you to go against the flow, which is not very easy. So that's why you don't see too many value managers in India. So that chapter, is all about styles and themes, and I try my best to really give as many shades of investing as possible. And the next chapter focuses on some sectors. For example, I take 7 sectors for a deeper analysis, including banks, NBFCs, information technology, energy, multinational companies that are based out of India, and I call them as Indian multinationals. Then you have the consumer tech, the Zomatos of the world today. And then you have international stocks. I mean, today Indians can invest in global markets up to some specified limits. So that also becomes a sector to watch. So each themes are discussed separately, because when you say sectors, we have good sectors and not so good sectors. And within that, we have good companies and not so good companies. But sometimes you may have good companies in bad sectors and bad companies in good sectors. So that is where the sector definition becomes very important. Our job is to avoid bad companies in good sectors, as they may have very company specific issues and may not be able to take advantage of a favorable sector atmosphere. And a lot of times we are obsessed with the banks, but in my research, I show that non-banks like NBFCs are a better choice compared to banks when it comes to long-term wealth creation, and like the Bajaj Finance, Cholamandalam, and what have you. So banks are of course key and big to an economy, but we have 22 banks listed and we have 16 non-banks listed, and they may not be as big as banks, but definitely from a return metrics like return on equity or return on assets or share price performance, the non-banks have done far better than banks. And here is a visual description of them. As you can see, if you plot them on a risk return scale, you can see many banks here in the negative zone in the long term analysis, but then you don't have any non banks in the negative zone here. So, non banks are a great bet compared to banks, as to what I discuss. And of course, I take information technology and I dwell into what are their modes, and I know and what are the risks for the information technology sectors from an exchange rate perspective, because they are highly dependent on A, exchange rate, and B, global growth. And in times like this, when global growth comes under pressure, I mean, information technology will definitely be affected. So I'm just giving some examples here, but the book deals extensively with each sector ideas a little bit more in depth than what is warranted.
Okay.
So from a plane point of view, of course, we are descended and we have landed, and now we are in a ground view. And this is, as you can see, gets very complex. And I give two templates here. One template is for banks, and another template is for non-banks, because for example, debt is a bad thing for non-banks, but it's the raw material for banks. So the entire way to analyze gets completely changed based on whether you're analyzing a bank or a non-bank. And I structure them as key metrics here, the financial metrics. I also look at non-financial metrics. For example, what type of foreign ownership they have, how long is the CEO tenure. I think leadership consistency is a very important factor for a company's success, and what type of research coverage this company enjoys. And within that, how many of them give positive recommendations and how many of them give negative recommendations. So those are qualitative issues. Apart from that, the quantitative issues like the top line, bottom line, debt equity, return on net worth, all those things are calculated. And then we have the third pillar on valuation. We have to see whether it is from a PE point of view or P by B point of view or EBITDA multiple point of view. And then you have other risk measures like beta and liquidity. The idea is I bring all of them together and I make them rank companies on a scale of 0 to 5. So I give an example here of Cipla, where I take each metric and I give the numbers and then I give the scores. And you can see finally Cipla's score is about 3.17. So on a scale of 0 to 5, this is 3.17. So basically, what I'm saying is that if you subject all companies to this template, then you will, if you start with say 500, Nifty 500, for example, most of the companies would be below 2, and you can completely eliminate them from your analysis, and therefore you can easily do what I call as funneling. So you start with a bigger funnel and then you come down to very handful of companies that you want to look at more closely. So this template enables you to do that, and I give a link to my Google Drive of this Excel sheet. So if someone wants to take a look at it, they can take a look at all the numbers of all the companies that they want to see.
Wow, wow, that will be great.
Yeah. And of course, as you rightly made a comment about benchmark, and the equity markets is all about benchmarks. And the index world is such a fascinating world to look at. For example, this is a table that I love because it gives the complete architecture of, say, Nifty indices. So you have, for example, at the top, Nifty 50, then you have Nifty Next 50, then you have Nifty Mid Cap, you have Nifty Small Cap, then Nifty Micro Cap. So the whole world revolves around index, whether it is Nifty or S&P 500. And this chapter is dedicated to understanding index. For example, who survived Nifty 50 all these years? Okay, this is a handful of stocks that has been there since 1996 in Nifty 50. Now, that's not a very small feat by any measure, because to be staying in the index for that long means something. Okay, indices normally has a lot of companies taken out and included. It's a quarterly ritual that they follow. Every quarter, they remove some companies and they include some companies. And if these companies have survived that process every quarter since 1996, then that shows something. So if someone constructs these survivors as a portfolio, for example, and invest, you can see the type of compounding that could have happened for
Amazing.
these companies actually. So for example, HDFC Bank compounded at the rate of 24% since 1996, and that's a duration of about 28 years. So at just 10,000 rupees invested back would have grown to 44 lakhs. And that's the story with almost all survivors. And then, of course, the Sensex has several dimensions to it. And I split them into four phases, actually, and analyze all the four phases separately, and how each phase can be very different from one another. So if you want to look forward, then you will have to expect a phase that is completely different from all these four phases, actually. So that's the whole idea of giving this chart. And if
Is
you
the
take,
next phase, sorry to bother you, can we go back to the slide?
yep,
So yeah, so you have concluded the for phase number 4, where it has
mhm,
produced high return, just like phase number 2.
yes,
And typically, after a high return phase, there is always a flattish phase
yes,
where a return should be much more muted in expectation. To has the
absolutely.
phase 5 begun?
Phase 5 has begun, and I am going to show you some numbers for that as well.
Oh wow, no, no,
Yeah.
amazing. That's why I asked the question at the right time then.
Yeah, absolutely. But before that, I just wanted to show you how the positions within the top 10 gets jostled from one to another.
Hmm.
And back in 2012, we had a list of these 10 companies in the top 10. And then 2022, we had some go out and some come in. And if I made a small exercise to just find out by 2032 who would be the top 10 and what would be their share, just to get some inspiration about how to form some portfolio ideas around these companies. But more importantly, that uh, uh, I think I have a chapter called Sensex Scenarios that I haven't included in the presentation, which shows what type of scenarios we can expect for Sensex in the next 5, 10, 15, 20 years. So that's again based on, as I said, when you construct scenarios, it has to be base case, best case, worst case type of a thing. And I would be very happy to share the findings of that. But that would essentially tell investors as to what they can expect the Sensex to be at a particular point of time, say 2030 or 2040 or 2050, whatever that is. Yeah.
Okay.
So that's again a very detailed exercise that I have done. And then the book goes into the most important aspect, which is to manage risk.
Yeah.
and volatility, because return and risk are the same, two sides of the same coin. And here is a template when some few just last year and before that, the Nifty has been at all-time highs, and that was clearly flagged as a market bubble. But how do you measure a bubble? Of course, just because a market is at its lifetime high doesn't make it a bubble unless it is backed by some nice studies. And here I give about 10 metrics to observe and rate them. For example, the first metric is the market cap to GDP ratio, which is what Warren Buffett is the favorite metric. So, if market cap to GDP ratio currently is about 106%, but the 3-year average is about 99. At the peak, it was 120, and the emerging markets average is only about 63. So when you benchmark India with this emerging market, clearly it is above normal. So similarly, we can take each and every factor and give a rating as to whether it is above normal, normal, or below normal. And if all of them scream, or most of them scream above normal, then you are definitely in a bubble.
Wow.
So, which means you need to avoid that market. And this study was made back in uh, 2024 July, the data, and the Nifty was at that time 25,000. So this study was reasonably close to reality if you just look at it.
Wow.
And then you also, of course, you have bubble, and then you also have bear markets. So what do you do when you have bear markets? Obviously, if you have a long-term investor, you do nothing. And if you are very active investor, then you try to average down, or you try to rebalance your debt and equity according to some ratio, or you, if your market is in a bear territory, but you can identify some foreign markets which are in bull territory, for example, Saudi Arabia, you can go and invest in those markets. But it's very important to remember your experience, in previous market cycles, and don't get steered by fear of missing out, the
Yeah.
FOMO. So that is the most important thing to deal with bear markets. And of course, the book dedicates a chapter to retail investing. Retail investing is a completely different ball game compared to institutional investing. And obviously, if you look at the asset class performance, if you take equity, gold, or fixed deposits, obviously you can see that equities have done far, far better than gold or fixed deposits. Gold is not bad, but definitely equity definitely triumphs. But Indian investors' exposure to equity markets is still not that high, and in spite of this asset class doing very well. And when it comes to asset allocation, I tell people that it is all about your familiarity with the assets more than the asset class attributes. For example, I divide the opportunities into familiar, not so familiar, and unfamiliar. Okay, for example, gold or real estate is a highly familiar asset class for all of us. Okay, but whereas, for example, sovereign bonds or IPOs are familiar but not so familiar. 1 in 5 will really dabble in all this. But then there is a long list of opportunities, like, for example, art, or hedge funds, or derivatives, or structured products, or cryptocurrencies. These are definitely unfamiliar for most of us. And if at all we are investing in them, it's because we get influenced by our friends and foes rather than a deeper understanding of those assets for us. So I say that the probability of loss for familiar asset classes is very low, liquidity is very high, and transparency is very high. Whereas for unfamiliar asset classes, the probability of loss is very high, liquidity very low, and transparency very low. So retail investors have to start thinking in this dimension when they commit to some investments. So, like Warren Buffett says, always invest in something that you understand and not what you don't understand. And familiar asset classes people bring a lot of understanding to them, whether it is gold or real estate or corporate bonds or fixed deposits or mutual funds. You have a lot of understanding. So stick to those that you are familiar with because of understanding. And financial planning, even finance professionals, chartered accountants, they don't take the help of financial planners
Yeah.
because for some reason we think very highly of our ability to manage money. And this do it yourself
Yes.
DIY is so popular, and with the doctors, with the lawyers, everyone wants to do it themselves. I tell people, please don't do that. We don't normally engage a financial planner because we are always overconfident about our ability. We don't want to pay a fee for a third person. We think that things are okay. I've done so far well. Why do I need an advisor? Or, yeah, I understand I need an advisor, but I don't know where to go and look for. Or I might say, I might think I'm too small for them. Probably they manage money only for very big, rich people and not for me. None of this is true. Okay, we should not be overconfident about our ability to manage money. We should not be reluctant to pay. We should not assume things are normal because things can turn abnormal at the whiff, like how we have seen yesterday. And obviously, if you ask around and do some research, you can always find that qualified financial planner to come and help you. And no amount is small if it is earned by you. So you should always be very proud of all the wealth that you have, irrespective of the size that you have it. And obviously, I propagate systematic investing in the market because study shows that it has always outperformed a lump sum type of an investment. So I'm sure you have a lot of blogs and podcasts dedicated to the virtue of systematic investment plan. And finally, I focus on some of the mistakes I made as an investor, while managing my portfolio. Obviously, I did not have endurance. Even 30 years back, I remember uh, investing and exiting, and I was just thinking that if I did not exist and if I had held on to that stock, how much better I would have been today had I had the endurance. And of course, I was affected by herd mentality. I mistook brands for profits. Just because a particular brand is a very well known brand, it doesn't mean it can generate money in the market. And indecisiveness is a big mistake. Okay, when markets fall, we think we can average on the downside. This is like catching a falling knife. And there is a big mental issue when it comes to dealing with the losses. For example, if you have a loss in your profit, you are normally very calm. But if you have a loss on your capital, then you are very edgy.
Yeah.
Both are losses, mind you, but the way you react to these losses are very different.
Yeah.
I have reacted negatively to capital loss compared to a law, and I also give some ideas on how to circumvent those. And of course, ensuring the portfolio through diversification and what have you is very important. And never, I mean, retail investors always, when they are successful, they attribute that to their skill. But when they are not successful, they attribute that to bad luck. So that also is a mistake which investors should not make. So that, in a nutshell, is what my
Lovely.
book is all about. And
Lovely. Raghu sir, you have just added one fan today.
mhm.
Amazing. I
Thank
did
you.
not have a single question because I think you are naturally gifted that the flow of the conversation was so smooth. Probably you have done it many times. So you know that these are the typical questions which will be asked, and you've already incorporated the answers in the presentation itself. I'm so curious to read the book. I'm going to order the book today itself, and I'm going to request all my learners who want to go deep inside Raghu sir's mind. I'm going to share a link below the video. Do buy the book. I mean, I don't have any commercial relationship with him. It's just pro bono. We are helping him to get the recognition. You know, there's so many books behind, sir. While we discussed, we also like the fact that I do read. 90% of the books are foreign books. And
Excellent.
every time I read a foreign book, I say that there's nothing extraordinary which has been written by a foreign writer that an Indian writer cannot write a book that actually prompted me to start writing a book. Hopefully, I'll someday conclude my book, but I'm very, very excited that I'm going to read your book now and go deeper into each and every aspect which you have taught today.
Thank you so much, Vivek. An absolute honor to get such a review from a person like you. You've been doing a great work. I have listened to some of your podcasts, and wow, what a spread and what an effort! It's brilliant. It's brilliant.
Thank you, sir. I think we all are in the same boat where now we have reached the stage of our life where we want to give back to society as much in the
Yes.
best possible manner. So, I mean, God is great, and obviously, our country is great, which is offering us opportunities. So, thank you, Raghu, sir, for this lovely conversation. I'll stay in touch with you, and let's keep on spreading the knowledge in our own way. Thank you.
Absolutely. Thank you,
Thank you,
Vivek.
Raghu, sir.
Thanks for this wonderful opportunity. Thank you.
Thank you.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.